Okay, so it is 2 o'clock. I'm going to just give it like one more moment before we really start diving on in, but I'll just give a little quick introduction as to who I am, a little bit of background about myself, and then I will pass the mic around for everyone else to introduce themselves. But my name is Michael Cadet. I am a loan officer with Cross Country Mortgage, and I've been with Cross Country Mortgage since 2022. I've been in finance since 2008. That's when I first got into mortgages, literally at the beginning of the whole financial meltdown in 2008. So that's the beginning and genesis of my whole journey. And the reason why myself, Lachey, Lorraine, we put these workshops on is because we have a passion to help people build wealth, and specifically just speaking to my own, personal journey, just being raised by a single parent mother and seeing what it took in order for my mom to be able to put me through school and all the sacrifice she needed to do, and the lack of financial just awareness and guidance is really what prompted me to go into the field that I'm in right now, because I feel like with financial literacy, it just opens up the doors for a lot of possibilities, and more importantly, it provides you with that financial freedom that we're all aiming for. All right, because we want to get to a place to where we can, enjoy the time that we have with our friends, family, loved ones, and really spend time in a way more effective way versus just working all the time. So we're gonna just talk about stuff like that. But that's just a little bit about me, why I'm in what I do, and yeah, please, Lachey, introduce yourself, and we'll just go around the circle. Oh, you're on mute. Oh, you're
Oh,
on mute. Yep, there you
okay, I got it. I got it.
go.
Hey, everybody. My name is Lachey. I am with Twin Oaks Real Estate. I've been a realtor for 21 years, and I enjoy bringing smiles and happiness to families, introducing them to this market and navigating them because this is like the biggest financial spend that you're going to ever have in your life is purchasing something. So just helping people, assisting people with going through the ins and outs. It's a stressful process, but it should not be if everybody's doing what they're supposed to do. So that's where I come in and help my family, friends, people that I don't know go through that transition. And we have Lorraine.
Hi, happy Sunday, everybody. My name is Lorraine Breaux, and I have actually been in real estate for 20 years. I'm also with Twin Oaks. We've been with Twin Oaks for approaching 3 years this year. Um, what I love about real estate is that you can, and no transaction is the same. But what I love is bringing families together, making sure that they build their wealth, also to help them through the process. I love when my families have said, "Oh, this is my favorite home," or "This is my second home." So just seeing people really grow, it can be a stressful process, but we are here to guide you through each of those steps. And with our team, we can guide you through that with as much breeze as we can, because there are going to be some bumps in there. So thank you for coming, and we look forward to this presentation. Thank you.
Awesome. All right, so let's jump into it. So, like I mentioned, this is going to be very interactive. I want folks to ask questions and get engaged. So please don't hesitate to drop a question in the chat or just raise your hand, and I'll be more than happy to call to answer on you. All right, but essentially today, what we're going to talk about today, hence the title of our workshop today, is going to be building wealth through real estate. Okay, so obviously, Lachey, Lorraine, myself, we help people purchase homes. That's our main function, is to help people purchase their home. Okay, now what we're gonna dive a little deeper into is because that's really the starting point. That's really gonna be the cornerstone of building wealth in this country, just in period, just real estate. The real estate piece has always been the piece that really kickstart the whole wealth accumulation for families. Okay, so we're going to walk through just what all that means and then open it up for questions and answers. So bear with me one sec. I'm just going to share my screen. And, here we go. All right. Can everyone see that? Nope.
Yes.
You can? Okay, perfect. Okay, so building wealth. All right, so what we're going to talk about is a strategy that that I teach all of my clients, which is the four quadrants of building wealth through real estate. Okay, but really, when it comes to just building wealth, generally speaking, there's really four quadrants that we're going to focus on. The first quadrant is going to be the real estate. So that's where myself and uh, Lachey and Lorraine and everybody, that's where we come into play and assist with. So we're gonna help you folks get qualified for the real estate transaction, educate you folks on what it takes to get into your first home, but the benefit mainly, obviously, as to owning the real estate when it comes to accumulating wealth is you have a few factors that are happening when it comes to wealth just accumulation in a real estate quadrant. Okay, so that first thing that you're looking at is appreciation. Okay, so I always say that like appreciation is more of a gift because it's not really guaranteed. A lot of factors goes into what causes your home or asset to appreciate in value. But this is a component within building wealth that's going to be one of your main benefits is that once you have access or have ownership of that asset, that's one of the functions of the asset is depreciation. Okay, so I like to boil it down to really three main things. You have the equity building, you have the tax write-offs, and then you have the appreciation, right? So every single month that you make your monthly mortgage payment, you're reducing your principal loan balance, right? And then in between, that's the equity that's being built. And then the tax write-offs, any interest that you accumulate over the course of the year, you're able to use that to write off that reduce your taxable income based off of the taxes that you had to pay, or excuse me, the interest that you had to pay on your mortgage. So that's another benefit. And then the appreciation, like I said, is more of a gift. Okay, so that's really the main big benefit to owning the real estate because if we're not owning the real estate, then most of us we're going to have to pay rent, right? And nothing wrong with paying rent. But just to put it into perspective, like what is the financial impact when we're paying rent? Okay, and so the financial impact, average rents in California is going to be about $2,500. So $2,500 is going to be your average rent in California. So just multiply that in 3 years. In 3 years, that's $90,000 that's just out of the pocket. And there's no benefit. There's no, other than putting a roof over your head, obviously, but there's no financial benefit, when it just comes to renting. And typically renting is like your first milestone when you're adulting is you need a place to stay. You need a place to stay. But the quicker that we can just realize like what is the financial impact and how that compounds over time and years, it really should hopefully prompt you to want to take that step and to get into ownership. Because if we don't own, then we're just taking the full brunt of taxes, of rent, inflation, and all of that stuff. So, I mean, that is the main reason why we want to educate folks on this. All right, let's get this thing out the way. Okay. So real estate, that is the first quadrant in building wealth. Okay. Let's see if I can get my thing to cooperate. Okay. So the four quadrants of wealth that we talk about and teach, we build and buy real estate. That's the first quadrant. Second quadrant is going to be survival money. So survival money, we like to break that down in just about like 6 to 9 months of whatever your monthly expenses are. So if you just take a tally, just add up whatever your monthly, expenses are every single month, times that by 6 to 9 months, and that should be like your first goal in terms of your liquid savings goal. All right. So reason why you want to put together like a survival account, what like we like to call a survival fund, is just for one, it creates a good habit. Right, creates a good habit of just getting in the habit of saving. Anything you earn, anyways, you should be taking at least like 15 to 20% of it and just tucking it aside somewhere. Whether it's in a savings account, a money market, or your 401k, whatever the case may be. But you should be doing that anyways, right? But the goal, I would say, the first goal, just to build out your financial house, is that those survival funds. So making sure that you have between 6 to 9 months of expenses saved and tucked away, and then ultimately you really want to try to get that account up to about 12 to 24 months. As things improve. Okay, so that's the second quadrant. Okay, because so if you're following so far, right now the first one we went through is the real estate. Second one is just the cash. Okay, so just having cash on hand. The third one is we're going to talk about investments. So, and again, the theme that we're talking about here is building wealth. It's just not about the real estate. Real estate is one quadrant of it. It's the biggest, and I would say one of the most important in the cornerstone, but it's the whole financial house that we want to build. All right. So, real estate's in the first, survival money in the second, investments. So, what does investments mean? So, investments are going to be things like, um, you know, oops, let me just mute somebody here. One sec. Okay, there you go.
Please mute your. Oh, there's you.
There you go. I just muted. All right. Okay. So like I'm like, and I've already kind of gone through. Oops. So I have more people coming in. So apologies if I have to just let these folks in. Okay. So first quadrant, like I was just going over, this is a very important one. So we want to purchase your first home, and the way I would like to that we like to say or teach in terms of like what's affordable for you, so that way you're not buying too much home, is that we want to advise to buy a home that's about 3 to 5 times of what your annual income is. So if you're making like an easy way to do it is like if you're making, let's say, $100,000 or so, times that by five, a $500,000 home is what you should be in to be somewhat comfortable. What that's saying is that you're buying a home that's just 5 times your annual income. That's typically what a bank is going to lend to someone anyways. Is about 4 to 5 times of what their annual income is. If you have some debts, like outstanding debts, credit cards, student loans, things like that, maybe just do that by three, and that would be, an affordable place to start looking at in terms of how much house that you should buy. Okay. So we talked about building equity. Other things that we want to talk about after we buy your first home, again, building wealth through real estate, is once we buy your first home, is to now start thinking about, adding to the portfolio, because that does add to your total net worth. Right. So we can start thinking about buying rental properties for your family, vacation properties. There's many uses for that, not only just for the family, but even for additional cash flow as well. And then on top of that, if you are going to finance it, there's tax benefits. You're still building equity and all that. You can even get into commercial, investments. If you're ever commercial financing and commercial real estate is a very, very lucrative industry and just segment. And again, why are we trying to? Why is this like even important at all? The real estate and all this. The reason being is because, right now, I'm not sure where everyone is, right now in terms of just like their, age, how close you are to retirement and all of that stuff. But I mean, really the goal is to accumulate these assets. So when you do want to start to wind down off of the work life, that you have assets that you can start pulling from. And that's really the goal, is just get educated on to like, what is it going to take? So when I do get to that age of retirement, that I have something to pull on, so that way I'm not, just relying on Social Security or just relying on whatever, small pension or whatnot that I may have, right? Because the main enemy of um, just building that retirement is the time. Okay, so it's really time. All right, here. This thing goes really slow here. Okay. So we talked about a little bit about quadrant two, survival money, what that all means. It's really, taking all your expenses, adding it all up, and saving that just for a rainy day. Okay, it gives you peace of mind, and also just has cash in case of any hardships do come up that you have that set aside. But really, it's for peace of mind, and also it's a good defensive strategy when you're building your financial house. All right. Quadrant three, retirement accounts. I'm hoping everyone, if you guys are still employed, or I'm not sure if anyone's in a retirement age or stuff, but if you are working and your employer does offer some type of 401k or employee match, I would highly suggest that you get involved in it because it's just free money. I mean, if they're going to match you, it's just free money already. You're already making 50% on the money that you invest in the 401k just by engaging in the match. All right. So again, this will compound over time, and the main uh, asset that you have right now is time. It's the time, because with a good plan, multiplied and coupled with time, it'll get you to exactly where you want to go. Okay. So there's tax advantages with retirement accounts. It helps reduce your taxable income and a lot of other benefits when it comes to that. And we talked, and then we talked a little bit about the investment accounts, mutual funds, individual stocks. There's ways to get into index funds and everything like that. Okay, so now I wanted to go over all of this because I wanted to give like a kind of like a 30,000 foot view of what it's really about in terms of accumulating wealth, not just buying the house. Because once you buy the house it can turn into just a liability if we don't plan it out correctly, right? So like the house is just a starting point because the next thing is once we get the house, then it's about let's protect the assets and then try to grow the assets. So things like putting the home in a trust, so that way your legacy is protected, and in the event that you need to pass on assets, it's done in an effective and financially smart manner. But again, this is about building a whole financial house using the real estate as the cornerstone. Okay. Um, so so that's about it in terms of the wealth accumulation, presentation and what it means to build this wealth through real estate, and all that good stuff. And if you do want to take that first step, obviously I'll drop all of our contact information for you to take the first step to purchase the home. But I want to open it up for questions. Okay, so we have a pretty good audience here, and I would love to just open it up for questions. And anything that folks have, you can feel free to just unmute yourself, or you can even drop a question in the chat.
Don't everybody speak out at one time. Don't be shy.
And if you don't want to speak, feel free to just drop your question in the chat, and then we can get into more fruitful dialogue. So everyone in here who is in here right now, how many of you are current homeowners right now? Could you speak to when you think? Okay, awesome. All right, so we got some questions here. So let's see. All right, so Nathan is asking, could you speak to when you think renting is wiser than buying? Great question. So, does Lachey, Lorraine, do you want to take a stab at that one?
Well, as Michael had mentioned earlier, you have to kind of look at your budget. So, depending on what your budget looks like kind of guides you as to if it's the right time to buy or not. So looking at your debt and everything kind of determines and will drive the wheel if it is a good time versus renting and buying. Depending on where you're located, California, the rents are high. So then you get to weigh if all of your things are in order, then you get to kind of weigh, is it better for me to buy at this time because of all of the benefits that that Michael had mentioned. So it just depends on where you are with your financials at this time and what that monthly would look like for you comfortably.
Right, right. And just to double back on that, absolutely. I mean, it's really the affordability. And so I always ask or advise folks like, if you can afford the monthly payment, that is the time to buy. If you can afford the monthly payment, that is the time to buy. And the reason being is because if you don't, then there is just uh, the circumstance that we'll find ourselves in. It's just we just have to rent. It's one of the other. You know, it's either we rent or we own. And so the quicker that we can get you to participating in building equity is the better play every single time. Okay, so like I mean, as long as we're just putting you in a position to where you're somehow offsetting inflation and you're able to accumulate, equity over time, that's the position that we want to put you in. You know, because the same dollar is not going to be worth the same dollar in 10 years or 20 years or so. And so we need to get you into an asset that's going to keep up with inflation and also set you up for when you do want to start pulling down on your assets. You can. All right. So Carla had a question, and I hope that answers the question. But if it doesn't, please drop another question. Carla, so she asked, so she does already own, and what resources do we have to just expand on? So if you already own, I guess the first thing to really take an assessment of is first like where are you financially and just in your financial life, if you're closer to retirement or are you more in your working years. That'll be just something I would want to understand. And then if it's more that you're in your working years, well, then we just want to look at ways we can continue to build out your wealth. Okay, so if that's by looking at how much equity that you have in your home, that's something Lachey and Lorraine can easily help you do. And okay, so got your age. All right, so yeah, so you're still, I mean, we're in the same boat. I mean, we're still pretty much in our working years, and I would want to understand like what is my equity position, like how much equity do I have? So what's the current value of the home versus how much you owe on the home? And then you have a good understanding of like, okay, this is what I have, and then this is what I can do with it, and then we can start having conversations with a financial planner because we're not financial planners. We are licensed to do real estate. The reason why I wanted to introduce all of these concepts is because that's a part of our extended team when it comes to like putting together trust and financial planners and retirement planning and all that good stuff, right? But the equity position is something that we want to identify because once we connect you with a financial planner, then we can take a look at that equity and see if we can diversify your assets, right? If it's whether to put it into a retirement account that's either performing better than the real estate asset or just keeping up with inflation, or if it's just a market you want to have some exposure to. But it would make sense to just have a sit down with a financial planner. Then they can do a full assessment of just like equity positions, all the options that's available to you. Okay. All right. So, and we'll more than happy to connect you with our extended team too. We have a great extended team of professionals that can help in all of these areas. So, we have a question coming in from Keisha. So, she had a question about how does student loans affect your ability to buy a house? So, great question. This comes up a whole lot. Lachey, anyone else you want to try to address this one? And it's kind of like a lone question, so but I'll just want to open the mic.
So basically, it can affect it in several ways. One in which they look at your debt to income ratio, and they are looking at your outgoing versus your incoming, what you already have, and where you're trying to go. So making sure that those things are taken care of or even lower, because what they don't want is to give you this loan and you're not able to pay it back. And so they want you to make sure that those expenses are low or under a certain percentage before you can go out and purchase other things. So if it's something that's extremely high, then working on that to bring it down a little bit more, and then they can assess everything. But the debt to income ratio needs to be at a certain limit
Okay.
so it can affect.
And so, and absolutely correct. I mean, so that is what the bank is going to look for, is they're looking really for three main things to qualify you for a loan. Is you're going to be your debt to income ratio, your credit score, and then your assets. Now, specifically speaking, in terms of your student loans, so there's really two types of main types of loans that a lender will try to qualify you for. So it's either going to be like a conventional loan or an FHA loan. Okay, so if you were to go through the run, there's different nuances and benefits between the two, but just specifically for student loans, if you were to go to qualify for a conventional loan, the way they're going to treat your student loan, depending on how it's reported on the credit report, will will be considered. So if there's no payment that's showing up on your credit report, if it's like in some type of deferred status or something, so if no payment shows up, then whatever outstanding balance that's showing up on there, conventional financing will just hit that balance for 1% of that balance, which will create the monthly payment. Okay, so if there is no monthly payment that's showing up on the credit report, that's how they create the monthly payment. So they have to incorporate that into your debt to income ratio. If you go through the route of FHA financing, well, instead of that 1%, they hit you with a half of a percent. Okay, so half of a percent. So in some cases, it may make more sense and just be more cost effective to go the FHA route versus conventional. And again, it's just about weighing the two options, and that's what we do. So hope that answers the question. But with student loans, I mean, there's also one more tip I'll mention too, is that even if there's like no monthly payment that's showing on the credit report, uh, and we were to hit it for either the half a percent or the 1%, sometimes that payment is going to come out pretty high, right? And so, what you can do sometimes, if you contact who's ever servicing the student loan, you can ask to have it put in what's called a income-based repayment plan. So they'll go ahead and just look at what your income is and then create a monthly payment for you based off of what's affordable, well, off of what your income is. And so that sometimes can come in as a lower monthly payment, versus hitting it for one or half of a percent, and which will improve and help the debt to income ratio. Okay.
I'm going to just throw out there, how does it affect if it is deferred?
Same deal. So if it's deferred and there's no payment, because again, we're just looking to see what the monthly payment is popping up on the credit report. So if no payment if it's in a deferred status, and it shows up in the credit report and there's a balance on there, but no payment is being reflected, then we have to just hit it for either the one or half a percent. But great questions. I think I had another question come in about investor friendly loan products, what investor friendly loan products that we offer. So we have a wonderful investor friendly loan product suite. So we have what's called a non-QM suite. Okay, so all the mortgages that you were to go get from like a Wells Fargo, Chase, they all come from Fannie Mae, Freddie Mac, VA, FHA, right? So they're all like government agency, loan programs. Now, when it comes to investor-friendly stuff, you want to have a lender that can just look at whatever investments you're getting into and just make it easy to get into. Because if you go into like a Wells Fargo, they're going to look at the performance of the asset. Plus, they want to see, how, financially stable and other income and sources that you have individually. So we do have a product suite that, like, for example, we have one that's called the DSCR loan. So if you're looking for like an investment property, We can extend the loan just based off of the performance of the property. So, meaning that we don't need to collect personal tax returns to qualify you. We're just looking at what the market area rents are and compare to what the debt is and down payment. Now, minimum down payment for those are going to be 15%. Most places they're going to charge about 20, or not charge, but require 20 to 25%. But 15% is going to be the minimum down payment. The main, I guess, component that you're looking for with an investor friendly type of a lender is just how many strategies they have, how many different ways they can qualify you for a loan, and if they're just flexible with like exceptions and things like that. Because I've seen some like pretty unique properties that I wouldn't even think would get financed, but if we put together a good storyline, a good narrative as to why this will make sense, then a lot of exceptions are able to get passed. But yeah, we have an awesome non or just an investor, product suite. So that question came from Nathan. Hope that answers the question. And one other one I'll say is like the like we have like a bank statement loan. So just again, easier ways to qualify versus just looking at your personal taxes. So we just take a look at what your average bank statements are over the course of 12 months, and then whatever that average is, we'll use that as your monthly income. Okay. So we had a question from Shania. She says she's a Caribbean mortgage agent based in Toronto. How would you help persons who want to migrate out of the U.S. Gain equity? I've noticed a trend of many persons between 30 and 50 migrating out of the U.S., but may not always know the best route how to do so, yet get their value for the home. So I mean, if we wanted to help someone migrate out of the United States, um, yeah, okay. If we want to help someone migrate outside of the United States, it would be just as the same kind of process that we would do to help someone just move, if like or move out of state, let's say. Lachey, Lorraine, they have an awesome network really all around, and I know if there was someone who was staying like in the country or in California, that is, and wanted to move to like Canada or something like that, they would tap into their network, connect with whatever local agents are in whatever market that particular person is in, and then as a team would start putting together a game plan to help them with that transition. So I'm sure, and I know Lorraine's going to talk more about that, but I mean, I would want to know like what my equity position is, what the values are in the place I'm going to be moving to. And that's where like Lachey, Lorraine, help facilitate. So, and I'll let them speak more on that.
I just want to add, so we would reach out to those depending on where they're moving to internationally, because we are licensed to sell in California. So, like he said, if we were going to Texas or Arizona, we would reach out to our partners in those places. And so, the same with those that are international, we will reach out to ones depending on, where they're moving to and connect them with the best agent on that end and loan officer on that end.
Yep. Yeah. So, yeah, but it's easy. Well, it's easy for us, I would say. But we help facilitate this and try to make it as easy as possible for you. And yeah, pretty straightforward. Let's see here. I think I just added someone in there, so I'm not sure who just joined, but we are pretty much in the question and answer phase. So if you have any like burning questions on your mind, if you wanted to even know about like first time home buyer programs and what it takes, the minimum down payment to get into a home, all that good stuff, and asking any question that you got regarding that stuff. Um, and just like because I did mention it, I mean first time buyer programs they are available. Um, Now, very interesting. I'll speak on first-time home buyer programs because I'm actually I literally just got someone into a contract this week, and they were wanting to weigh between the option of using a down payment assistance program or just using their own cash. And this would fit for someone who has like 20% or more, who just essentially just has their own cash. And the reason why I want to kind of explain this is because when folks hear down payment assistance, they're like, "Oh, free money, like that's for me." You know what I'm saying? That's a benefit for me, right? But and it works. It works for the right type of person, for the right type of person in the particular situation. So so in this scenario, person had 20% down and they were like, "Hey, I heard about, down payment assistance. I want access to the money. If I don't have to use my own money, why should I have to?" And I was like, "Okay, well, let's take a look." And so as we looked at it, because the down payment assistance has to be paid back at some point. It's a silent, and there's different types out there, but the real popular one, which is like the Cal Hefa down payment assistance program, it has to be repaid back at some point. And I can get into all the nuances between the different down payment assistance, but just for the sake of this example, they were going to put 20% down, and they wanted to see if they can use the down payment assistance. And actually, when I calculated it, I ran both scenarios side by side to each other, and actually just by using their own cash, their equity position in the next 3 years was going to be higher versus if they were to use the down payment assistance. Okay, so yeah, so I mean, because again, let's just say in 3 years, because right now let's say rates are trading between 6.5 to 6.75%. Let's just say in 3 years, interest rates come down to like 4.99%. And that person who purchased their home with down payment assistance wants to refinance to get a lower monthly payment. So in the event that they refinance, you're going to have to pay back that down payment assistance. Okay, so that's essentially removing equity that you built over the last 3 years from you. Okay, so it would have helped them in terms of cash in order to get into the home. But in terms of building equity, because that's what we're talking about, building wealth through real estate, is that's where it would have impacted them a bit, is where, when it comes to their equity position in a few years, um, that's where it would have hurt them. Keisha had a question about down payment assistance. Is it available for a second home in another state, such as Texas? All of the down payment assistance programs that I've researched, all are going to require that you occupy it as your primary residence. So there's typically not like down payment assistance for second homes or for investment properties that I'm aware of. I've looked at a lot of them too, and I've not seen any down payment assistance programs for second homes or for like a um, investment property. But Texas, in every state, they're going to have their own down payment assistance programs. California has Cal Hefa. I know I helped my cousin in New Jersey. They have their own down payment assistance programs. I had some family in Atlanta. They got their own down. So every state has their own down payment assistance. And everyone is not equal, because some have specific terms in terms of the repayment of the down payment assistance. So, like I was saying in that first example, they just have to repay it in the event that they sell the property or refinance it. That does impact the equity position and will help you get in if you don't have the cash. But it's just that's kind of the trade-off is the equity. Um, but yeah, it's just a matter of just like research and understand the terms, because some of them they have what's called this shared equity feature that's within the down payment assistance program. So what that means is that because it's the equity we want to protect. That's what we're trying to protect. So the shared equity is like in the event that you decide to sell the property or refinance the property, what they're going to do is whatever down payment assistance that they provided you, they're going to claw back the down payment assistance and then plus 20% or whatever amount of equity that appreciated, they'll claw back that as well. Okay, so I've seen that in quite a few down payment assistance programs. Like there's one here in our local area in Solano County, the Dream for All program, which was offering like 20% down payment assistance with people. That was the feature that was in that program. So we just have to understand what the terms are, what's the trade-off, if to see if that makes sense.
And I
Um,
just want to piggyback off what Michael said. And it also depends on the county because I know Alameda County has right now a different program than Contra Costa County. So depending on where you are, there's also different programs depending on the county.
yep, yep, absolutely, absolutely. And we work with all of those like local municipal programs as well. And a part of my job is just to, educate. It doesn't really matter to me, like if you go with the down payment assistance program or conventional FHA. My concern is to get you into the home, start building equity. Because once we can get you in, if you're like renting right now, we can get you in, then we can strategically manage the debt down the road. Like, because there's going to be opportunities to refinance, to restructure your loan depending on what your current lifestyle is, job changes, lifestyle changes, and all that stuff. So it's a matter of just getting in. We just got to get you in, somehow. All right. Nathan had another question about on the investor side, do you have term sheets for your DSCR loan? So Nathan, I will connect with you after, and then we can go over specifically just in terms of like what your scenario is and term sheets and all that good stuff. And I have your contacts, so I'll email you some stuff after we hop off here. But these are great questions. Great dialogue, y'all. I appreciate the engagement. This is great. And like I mentioned, this is about the wealth accumulation. As we spoke in the beginning, the real estate is the cornerstone. We got to get that part down. That's the first step. Once we have the real estate, it just opens up so many other doors, just financially, um, in terms of time, because we want to get your time back, because time is one of our most valuable, assets that we have is time. Time. I have a 3-year-old little boy, and that's all I want to do is to spend time with that 3-year-old little boy, But the more that I have to work, the more I got to spend time away from that little boy. So, this is the type of stuff that, uh, we want to share with our folks and share with the people who believe in us and, help them take that first step. But any more questions, feedback, anything like that, please drop them in the chat. Still got plenty of time here. There's still a dialogue. I would like to ask like Lachey and Lorraine a question. Maybe they can share something with the group. Just wanted to see like as realtors, you work with buyers, you work with sellers. Kind of what's kind of the landscape that you're seeing in today's market for someone who's looking to either buy or sell a property. Like, just kind of what's your take on the temperature of the market right now? Is it a good time to buy? Let's start with
It's
that.
always a great time to buy. I'll start off and then I'll pass it on to Lachey. But it's always a great time to buy because with equity, I mean, with property in California, it always grows. I know the interest rate is a big deal for some people, and that's why for first-time home buyers, there's different programs and there's different ways to maneuver and strategize with that. You can do buy down options. There's so many different things that people aren't aware of, and that's why it's so important to team up with an agent so that you can kind of see what it is because you might think, it may be $4,000, but again, there's ways to strategically change that scenario. So that's one of the things, but it's always a great time to buy.
Absolutely. What's your take, Lachey?
I would say it just depends on every individual circumstances. Everybody's not in a predicament to buy, and that's okay. But that's the goal eventually is to get you to purchase a home. And then once you're in that home, to get you to start on your next move and think about it. And that's where the financial planner comes in to see if, okay, should we put the equity reserves into a different account or should you go ahead and start purchasing your rental property or another home or something like that. But it just depends on each individual. But like Lorraine said, it's always a good time to buy when you're ready. but
Absolutely.
we're here to assist when that time comes. And if you didn't know, like realtors, they always ask us about loans information. We know the basic stuff, but I stay in my lane and I send my people over to Michael. That's his lane. And he has all that information, some stuff that I don't have and I don't know. And then vice versa. I have that information that he doesn't know. So he'll send you back to me. And then that's when we do the process. But yes, anytime is a good time, depending on your circumstance.
Absolutely. Absolutely. No, and I agree. It's the interest rates, there's always a conversation, and I'm sure everyone on here has heard the narrative because a lot of folks um a lot of folks when they hear about financial information or financial news, they get it from just mainstream media. And the main thing that like mainstream media is going to focus on is interest rates, right? So I got your question there, John. I'm going to address that in just a second here. So like interest rates, right? And that's what I want to help you folks maybe shift your focus off of. All right. And I know that may sound counterintuitive, but it's the truth. Because think about it like back in like 1980s or the 1990s. All right. If you can recall, I don't know if anyone was paying attention to what rates were back then, but they were like in the 15, 16%. And people were still buying houses. Now, obviously, home prices were a lot different. So that's all relative. But still, it really wasn't about the interest rate number. It was still about the monthly payment, right? And so, kind of like what Lorraine was saying, it was like it's the monthly payment. There's strategic ways that we can help you get to the monthly payment. For example, I'll share real quickly, and I'll get to John's question. Is like the monthly payment average rate right now 6.75%. Okay, so there's ways to start off your interest rate journey in year one, even in today's interest rate market, at 4.75%. And that'll save you a whole bunch of cash just upfront in terms of cash flow, every month to month. So, I mean, there's different strategies to do that. The strategy I was just mentioning, that's called the 2-1 buy down strategy. I'll even send you guys, like after we get off here, I'll send you like a little video that I put together for my clients to explain and show visually like how that impacts your monthly payment and the strategy behind that. But there's strategic ways to accomplish that monthly payment. All right. So John's question is to speaking on wealth building. Can you speak on the Rockefeller method of building wealth? My understanding is that it uses trust, insurance policies, real estate, etc. So this is a very, very deep question, okay? Because there's a lot of moving components. I'm very well aware of their methodology. Um, I believe it's called the waterfall strategy. I think they call it. But essentially, what happens, and I'm not a financial planner, so please don't hold me to any of this type of stuff. This is just kind of generally speaking. But the way they do it, they pretty much protect their wealth through a structure of like insurance policies, really mainly insurance policies and trust. Okay, uh, so essentially, like they put a life insurance policy or benefit on anybody that's in the family. Okay. So for anyone that's in the family, and essentially what they're creating is like what's called a family bank. It's kind of what they're trying to create. Okay. So, and I'm not like super well versed in this. Okay. So I just kind of loosely understand like the loose concept of how it works. But essentially, any family member in the family, they get an insurance policy. And then in the event that if that person passes, then that insurance benefit gets paid out, and but the funds don't go to the beneficiary, but it goes back to the trust. Okay, and then the trust just goes and repurchases another X amount $1 million policy, and then that cycle just keeps on going and keeps on going generation after generation. And so essentially the whole generational wealth gets built by these insurance benefits that get handed out once a person passes away. So again, this is just like a real loose explanation of how that of what that is. There's plenty of like YouTube videos on how the waterfall strategy works, or just look up the Rockefeller wealth building strategy or something like that. I'm sure you'll find plenty of videos on it. But it's a good strategy. It's the strategy wealthy people use by by incorporating life insurance policies, definitely having trust in place. That way, you avoid having to go through probate if you ever have to pass on assets to family members. Um, and so, yeah, that is where the financial planner within our extended team comes into play, right? Because that they're going to speak more specifically and strategically when it comes to structuring your insurances, policies, protecting your kids, heirs, and your trust and all that stuff. So that's why we bring in those folks at that juncture. All right, so Keisha has a great question. I'm going to let Lorraine or Lachey answer this one, but Keisha is asking, when is the best time to sell? How much equity is safe to look into buying as well as renting your property? Great question. So I'll let Lorraine or Lachey, y'all want to tackle this one? Because this is not my lane.
Okay. It all depends on what is the need of the reason why you need to sell, how much money you need out of there. People have different situations on why they have to sell. Um, and with as far as the equity, it depends on if you're trying to buy another property, because then you have to look at the tax purposes of that as well. So
Mm.
it just depends on really what the need is. If it is that you have to downsize, some people are going through situations in life where they have to kind of change some things up. So it kind of depends. Um, the best time to sell is, when the homes are higher and they're not kind of sitting on there a little bit longer as they are currently. But it just depends on, too, again, what is the need and how much equity you need out of it in order. Are you trying to buy another property? Are so it always depends, as Lachey mentioned earlier, the situation. So we have to look at the whole picture and able to kind of answer that um, in a better light, if that
Yeah,
makes
because
sense.
like it's hard to, I would say even impossible at times to time the market, to try to like time exactly when you should get in or get out. So it's, you again, like Lorraine Lachey is saying, what is the situation? Like some situations is I have a job in New York I gotta go to and I need to sell the property. Okay, well then this is where the market is at. This is what you'll walk away with. Lachey, I think you had something to say too.
Um, I was just going to say, just like I'm going to give my mother as an example. She purchased her home back in 2011 for $180,000. And that's when the market was like trying to rebound off of 2008. It was still low. Interest rates were very low. Now my conversation with her is different. What are we doing? She's 65 and I want her to be able to retire, but she doesn't want to just sit around, right? So I want her to make her money work for her. So that's either get a rental property, she doesn't want to deal with that, um, or just put somebody in her house and then come live with me and I'll deal with it. But as you start getting older, it's really, really important that you start thinking about when you're up there and if it's time to get some income property. The whole point of retirement is to make your money work for you, not you still working and stressed out and not able to live. Like when you're 65, 60 years old, you don't have that much of a time until you're 100 years old. So the whole point of us having these conversations with you all, the ones that we love, people we don't know, is just to educate on what's best for you. We don't know what that looked like. We don't know what your personal issues are. We don't know if you have to sell or if you just want to be able to have stability and financial, wealth, or just want to have something to rely on and make your money work for you. It's just depends on everybody. But going back to my mother, it's just like now we're at this crossroad to where it's like, okay, you're at the threshold. What are we doing? So being that I don't know how old everyone is on here, it's just like we're having this conversation now. So then you can start planning for those things. And when you're 65 and 70 and 75, to have your money working for you when you're not still working for your money. That makes sense.
Makes sense to me because I'm not trying to work until I'm 100. I don't know if I can. I don't know if I'll be able to. um, but
And I
yeah.
see that Keisha says she would like to buy a second property. Keisha, is that in state or out of
So
state?
yeah, I wanted to address this question because this comes up a lot. Where folks they have idea in their mind to where it's like I want to buy a second home and I want to and Keisha said out of state in Texas. And that may make sense and I'll explain kind of what my train of thought is here. But like so when folks come and ask me like, hey, I want to buy a second home and rent out my departing residence. Okay. And typically the reason why they want to do that is because, they're trying to accumulate wealth. They're trying to build their wealth and they want to create more cash flow. And then so my first question is typically is like, well, do you want to be a landlord? Is my first question. Do you want to answer the phone at 2 o'clock in the morning because a pipe bursted and you got to drop, you got to deal with all that? That's my first question. And some people are like, no problem, all good. I like that type of stuff. Okay, well, great. Okay, let's start with that. So you like it, it's cool. You can, you have the mindset to be a landlord essentially. Um, second question I'm going to ask is the cash flow going to be a net positive or is it going to be a negative? Right? Because the whole point is to positively cash flow. Now in California, because prices are so high, you're gonna have to put a very large down payment in order for it to cash flow, respectively. Now in the state of Texas, where home prices are just a little bit lower relatively, to California, that may make more sense as long as it cash flows. But just one other idea that I want to introduce is that instead of rent, moving to another property or buying another property and keeping that one, it may and sometimes make more sense just to sell that property, take all the equity, and then just put it into a bigger and better performing asset, right? Because essentially the whole goal that you're trying to accomplish with renting it out and doing that is to build the equity and accumulate a little bit of cash flow, along the side. But it's probably going to be for one or two doors, so it's like, is the headache and worth the cash flow that it's going to produce, depending on how much that is. So it's just an analysis thing. We just have to analyze what is going to be more cost effective. Is it going to be more cost effective just to sell the property and then just take all the equity and just buy a way bigger and better, performing asset, or we're just going to be able to just take a small portion of the equity and then whatever that portion is will only afford us whatever that we're able to tap into, if that makes sense. But to answer your question, I mean, we can look into it and see if it just makes sense or if that's something that you want to do. And we may even pencil it out to where you're like, you know what, I can just sell this property and I can just buy a way bigger house. And, and actually the equity, um, accumulation will actually accumulate at the same pace if I were to keep both properties and less headache in that scenario, but more than happy to analyze it for you and see what makes sense. Okay, but this was great. So I know we're coming up on our hour here. So I really, really appreciate y'all hanging out with us. And obviously, we're still here to answer any questions and stuff. But What I'm going to be doing, and Lachey and Lorraine and us, we're going to do after we get off the line here, is we're going to reach back out to everybody, just connect, schedule a follow-up call with you all, and see if there's anything that we can do to help you take that first step, whether it's to buy your first home, whether it's looking at purchasing a home in another state or another country, even. This, that's going to be the purpose of the call. It's really what we like to call a discovery call, just to discover, what's going on. How can we help? We will be having another one pretty soon. So as soon as we get that date and all that stuff, we'll shoot some communication out to everybody. But I really am so happy that you guys came out and hung out with us for a little bit, and we got to share our information. And yeah, I'll let Lachey and Lorraine close us out.
I just want to say thank you all for participating and coming, and we are here to help. So if you have anything, but again, most definitely thank you for coming in today.
Thank you guys for taking an hour out your busy Sundays to come and hang out with us. We greatly appreciate it. Again, John, I'm going to reach out to you about the life insurance part and piece of it, and speak with you about what all that entails. But yes, that's a very important piece to have when you're buying a home. If you have a home already, making sure that the assets are protected and in place to where it's not going to go to probate. We don't want your stuff going to state. It doesn't make sense to have something if it's not structured correctly. So, with that being said, I thank you guys. We are going to figure out our next meeting time, and we're going to have a financial planner on there this time. That way, they can talk about that part, because we don't like to go in other people's lanes, right? We know the basic parts of it, and that's what we can speak on, is what
Right.
we know. But to dig and jump into somebody else's lane, we'll let them talk about their piece. We're going to stay in our lane, and then we will see you guys next time.
Awesome. It's such an honor. Take care, y'all.
Bye.
Peace.